Okay, Rick, thanks for joining us for the quarterly update. Once again, another very good quarter for the market, but also relatively for you guys as well, outperforming your benchmark yet again, making a habit of this, Rick.
Yeah. Thanks, Rob. Thank you very much. My pleasure to be here. Again, a good habit to have. We're very happy to have one like that. You're right. Very good quarter for the market. The strongest start to a year since 2019. I think the market, as we define it, was up 8.2%. And as you're right, we basically had a very good 3 months, and the portfolio returned 13.4%. So we outperformed the market by 5.2. And as you say, since inception, now we've been running over 5 years. The portfolio has delivered 17.4% per annum compounding, versus a market at 11.5. So we're very happy with the results so far.
Yep, no, great work. Now, speaking of results, reporting season, what were your thoughts?
Yeah, look, reporting season started off well. In saying that, look, it's basically been a strong start to reporting season in a market that's correcting. So I think at the beginning of the year, treasuries were pricing in, at the most 7 interest rate cuts from January. And what we're seeing now, Rob, is essentially a very resilient economy, very sticky inflation, particularly service sector inflation has been very sticky. Inflation prints are still higher than expected, higher than the targets of the central banks, and essentially the market is now pricing less than 2 rate cuts for this year. And realistically, we'd probably be looking at a prospect of no interest rate cuts this year. So bond yields are backed up. Bond yields are backed up pretty meaningfully. I think from the beginning of this year, the 10-year Treasury was around 3.85%. It's now around 4.5, 4.6. And obviously that's been a headwind to markets. Now the markets, as you mentioned, have had a good reporting season, but there was a lot priced into equities, and this is why the portfolio was carrying around 12% cash, and still is carrying around 12% cash. We both saw that the markets were fully valued, and obviously we were less optimistic on the prospect of rate cuts than the market was at the beginning of the year. So yes, we've had a pullback. I think look, the Dow Jones has lost all of its gains since the beginning of the year. The S&P, I think, is down around 5. And as you said, look, JP Morgan, which we hold in the portfolio, had a very good result, a good profit beat, maintained its guidance for the year. Look, voiced some caution in the outlook statement, really around geopolitical risks and stickier than expected inflation, and the market basically sold it off 6.5%. It's recovered a little bit since then. The same thing with TSM, Taiwan Semiconductor Manufacturing Company, which we own in the portfolio. Another beat, a bit of caution in the result, sold off a little bit. It's recovering. Very, very strong result from Visa last night. Also, I guess, heralded by the JP Morgan result, which talked about strong card growth. So Visa actually has come in with a ripper result. We've got a very large holding in that, so that should be a good fill-up to our returns for this month, or this quarter moving forward. So look, reporting season has started strongly. There's a lot priced into equities, and that's normalizing. Longer term, though, moving forward, we're still very constructive on the outlook for the markets. Again, just a little snippet I wouldn't mind sharing, if that's all right. And we haven't sort of seen this too widely spoken about, is that just the balance sheet and the health of the US household, the US consumer is still very, very strong, and there's still a great degree of wealth looking to find a home, and this is really sort of, I guess, illustrated by home prices in the US since the pandemic have risen by around 45%. And on top of that, home equity ownership or equity in homes has risen to around 70%. So when you multiply that out, it's about a US $12 trillion gain in the value of US households, the US consumer, and that was pretty much reported by Home Depot in the previous quarter. US 12 trillion is basically larger than the combined market capitalization of the Magnificent Seven. So obviously that will be, or a portion of that will be looking for a home moving forward, in the sense that homes in the US, or mortgages in the US, are based on far longer dated bonds than what we have here, and they're not facing the same mortgage cliff that we've been basically hearing about here. So look, a great sort of positive wealth shock, and that should lead, I think, to the prospect of further investment and support for the market moving forward structurally.
I guess probably the flip side, the US government, their fiscal position's not looking so good.
No.
But in saying that, what they are doing is they're spending money hand over fist, which basically goes into the economy and the corporate sector.
Yeah, look, I mean, obviously, you've got the election coming up this year, and how can I say, is it a case of the lesser evil? I don't know, but look, they're very much focused on America first, and then obviously moving forward from there, as you say, how that's going to basically flow through to corporates and a good fiscal environment for the economy overall. So I mean, look, it's you're right, and I think that comparing, I guess, where they are and the outlook for the US and even the Eurozone compared to where domestically where we are, where effectively, we're very much tied to the outlook of China for the sale of our commodities, and the Chinese economy is still struggling. And obviously, we've got a very our banks are expensive, and our banks essentially are savings and loans businesses. You've seen Citibank pretty much Citigroup put all four of the major Australian banks on sell. You've got CommBank, I think, trading at about 2.8 times book value, which is incredibly expensive, and that was at a time when its margins were higher than what they are now. And if anything, I think you'll be seeing a fair degree of margin compression in the banks here. So look, again, I'm not an expert on the Australian market or the Australian banking sector, but just from a relative valuation argument, we're just seeing a lot more opportunity and a lot more value offshore in economies which we believe have a broader outlook moving forward than what Australia does.
Yeah, and I guess the Australian banks are always an interesting one. They always seem to be way higher valued than their offshore peers, and arguably their offshore peers have got more scope for growth. So none of that makes
and look,
sense.
it's lack of choice. It's lack of choice, and obviously, as you say, I mean, you've got the offshore banks, as JP Morgan, Goldman Sachs had a fantastic result last night as well. These banks have more arrows in the quiver, having full investment management businesses, corporate banking and stuff like that. Realistically, you've got the banks here are very much tied to a very expensive property market, and essentially a consumer that is struggling under cost of living pressures, and that's pretty much it. And then you've got obviously the risk of a left field or a black swan event where the government's going to come in and start to shake things up because people can't afford to make ends meet, and we saw that to a degree with the utilities, in the electricity businesses and stuff like that, the retail businesses. So, not saying it's going to happen, but what I'm saying is that there's less visible opportunity and greater challenges to overcome, in my opinion, anyway, with the domestic banking and the domestic banking sector versus offshore, where they've got broader based businesses and diversified revenue streams.
Sure. Now you mentioned China.
Yep.
Obviously, China's going to have an impact upon Australia. From your perspective, do you guys have a look at China or as a possible investment thesis? Where does that fit into play?
Look, we do. I guess, I mean, throw China into the mix, Rob, of emerging economies where we try and manage risk by investing only on developed first world bourses, look, we get exposure to emerging economies through multinational companies where it's an avenue of growth for them moving forward, and if something does go a little awry, it won't sink the company.
Yeah.
And so we don't invest in China directly, but but we do look. And to tell you the truth, we've been doing actually a lot of work on Indian banks. So obviously there you've got a democratic economy. The professional population is well educated. And you've got 1.4 billion people, and it's growing strongly. The return on equity and the return on equity and the valuation of those banks are phenomenal in a relative and absolute sense compared to sort of what you see elsewhere. So we've been doing a bit of work on them, and we'll just sort of see how that plays out for the portfolio in the future. But there is opportunity for sure.
Yeah. Okay. Excellent. All right, Ric, is there, mate, I guess from our perspective, the one thing that did catch our attention over the last quarter was definitely the backup in bond rates.
Yep.
I guess from your perspective, what are the key things that you're keeping an eye on at the moment?
Oh, well, look, that's one of them, obviously, Rob. I mean, we believe that rates will normalize, at levels lower than this. It's just obviously going to take longer. And from the market's perspective, there's not much difference between being too early and wrong. Look, obviously, it's just the same thing. It's all about just keeping an eye on inflation, on the labor market. As I said, look, the economies have been remarkably resilient, which is great on one hand, but on the other hand, it basically works against it's a headwind to bring down inflation. I mean, the USism, I think, recorded an expansionary reading for the first time in 16 readings in last month. Inflation ticked up a little bit there. Also throw into that geopolitical issues. So that's one thing which is obviously going to be weighing on the market a little bit, and obviously if there are bottlenecks associated with that, leading to obviously causing inflationary pressures. Obviously, what's happening in the Middle East, tensions between the US, Russia, and China should not be ignored. But in saying that, the market is still at or near a record high. I don't understand personally why the gold price is where it is. That's just my shortcoming in saying that. I've been looking at, I'm a geologist by trade, and we ran a global resources hedge fund for 10 years. And essentially, the gold price is negatively correlated to the US market, to equity markets, and we got a market at or near record highs. It's negatively correlated to the US dollar, and essentially, we've got the dollar, especially versus the yen, being relatively strong, I guess, for the relative interest rate outlook. And with respect to geopolitical issues, well, look, I mean, it's a little bit like putting the frog in the boiling pot of water. I mean, we've had these issues around for a while, and the market's sort of not accustomed to them, but has accommodated them to the point that the market was at and still is at relatively healthy levels. And the oil price is back to sort of near long-term average levels, give or take a little bit. So it's interesting. It's a little bit incongruous to me. And the same thing also with copper prices and commodity prices, where the world's largest consumer is struggling. And we've got copper prices well over $4 a pound. So I don't know if it's a relation to bottlenecks or whatever. Obviously, look, real assets like copper and gold do well in inflationary environments, but it's usually at extreme levels. So it's a little bit hard to understand, and that's obviously why we don't have a lot of resource exposure in the portfolio. We still have Shell. More though for the thematic of decarbonisation and still the need for gas to fill the hole that will be left by renewables not delivering. And also Shell in itself is cheap, and it's essentially undertaking a strong buyback program, has lifted its dividend as well. So look, that company also is held on micro reasons as well. So I guess it's just a moving feast, and like we've seen for the last 5 years, there are a lot of things that are playing out. We still have an inverted yield curve too in the US, so it's it's tricky, but look, that's why I think, active management is the way to go versus something that's passive. I mean, Tesla last night, case in point, had a horrible result. I think earnings came in at 45 cents versus, I think, an expectation of 52. And now Tesla is basically turning out, sort of saying they'll be looking to deliver cheaper cars in the future to try and bridge that gap, because people really can't afford EVs at the way they're priced at the moment. So just a lot of things happening at the moment. But, all in all, I think that we're very happy with the way that we position at the moment. We're in good companies. We're very comfortable with the valuation of the companies that we have. And we've got, as I said, 12% cash that we're waiting to redeploy, when opportunistically, sort of when prices present themselves, or we're working on new opportunities as well. But what's happened at the moment, we were largely expecting. So, we're happy that we sort of read the market relatively well, and now it's a question of making the best of the opportunity that's presented itself.
Excellent, excellent. Well, Ric, mate, thanks again for your time, and keep up the good work. And we'll talk again next quarter.
Yeah, thanks very much, Rob, and also thank you to Shartru and all the clients we've got from you guys, and for supporting a product. We very much do appreciate it.
No, that's great. Thanks,
Okay.
Ric.
Thanks. Speak soon, Rob.
Cheers, mate.
Thank you. Ciao.